Hello and welcome to another episode of the Federal Church Presents Reverend Bloomberg. Continuing our coverage of the global financial system collapse 2023, the worst ever. Well, it's mainly the banking system failure in the U.S. And what we have here, another good note from Zero Hedge. Fed seasonal shenanigans continue as adjusted domestic bank deposit outflows grow. Amid endless fuckery by the Fed, technical term used to describe the seasonal versus non-seasonal deposit flows, their large adjustments over the last weeks. Basically the shenanigans they're pulling, fudging numbers, and taking a look at banking deposits and seeing how essentially the banks are failing in the United States. They're all insolvent. So, of course, depositors are going to take their money out of the banks and put it in they've been doing is putting it in money market funds that are yielding 4% versus the 0.5% in the depository banks, depository institutions. But, again, that's an issue, too, because I don't think they've figured out how money market funds work yet. We look forward to seeing what Powell and his pals have for us. As a reminder, the prior week saw bank deposits tumbled by 79.2 billion. Sorry, I'm on medication here. Seasonally adjusted, biggest drop since March 22 as deposit flight returned. Again, the banks are insolvent, and they get more insolvent by the day. Unadjusted deposit drop was even bigger, 86.6 billion, which brings us to the latest week, which we would expect to see significant non-seasonally adjusted outflows ahead of corporate tax day. Instead, of course, we see inflows on a seasonally adjusted and non-seasonally adjusted basis. Seasonally adjusted total deposits rose 17.6 billion in the week ending June 14th. Non-seasonally adjusted deposits rose 44.6 billion. And these figures are a little misleading. On a seasonally adjusted basis, there was a large foreign bank inflow, 32.2 billion, while large domestic banks saw 17 billion in outflows, offset by a small 2.3 billion inflow to small banks. On a non-seasonally adjusted basis, also all cohorts saw inflows. Large domestic 24.2 billion, small domestic 9.8 billion, foreign banks 10.5 billion. Which means overall domestic banks saw outflows of 4.6 billion seasonally adjusted and inflows 34 billion non-seasonally adjusted. Most notable thing then is the largest foreign bank deposit inflows since July of 2021. And you probably don't want to keep your money in U.S. banks. Though on a non-adjusted basis, things are a lot more normal. On the other side of the balance sheet, after a big decline last week in large bank loans, both small and large banks grew by about $8 billion each. Reminder, amid this deposit flights, banks are borrowing a record $102.7 billion at the Fed's Emergency Bank Term Funding Program facility. Again, if they weren't insolvent, they wouldn't be needing to do that. This is a note from yesterday. Fed Emergency Bank Bailout Facility. Usage hits new record high. Money market funds see another small outflow. There was also another good, what do you want to call it, tidbit here. Yellen said more banks will probably seek to merge this year, meaning more banks are going to fail. It's from the News Squad market wrap there. But for the second straight week, money market funds saw outflows falling 8.2 billion, the biggest weekly decline since Christmas week 2022. Now, I don't know where they're putting their money, but, blockchain would be a better idea. And for the second straight week, again, it's going to the moon. All the outflows, and that's another part too. You see it in the market rip. Apparently that stuff is up about 25% from its lows in the recent weeks. Crypto, I mean. But back to the banks here, and for the second straight week, all the outflows were institutional, minus 24.89 billion, while retail funds saw a 9th straight week of inflows. Is this related to the chase in the tech stocks? Money market fund outflow, which leads banks deposit data by a week. It's an indication. It's interesting because it comes after banks saw a huge deposit outflow the prior week. Haven't gotten nowhere for 2 weeks. The Fed's balance sheet shrank by $26.3 billion last week, basically back in line with pre-SVB levels. As far as QT is concerned, the Fed sold a decent $9.4 billion of its assets, down to its lowest since August 2021. U.S. central banks has $106 billion of loans outstanding to financial institutions through its two backstop lending facilities. Banks' usage of the Fed's emergency bank term funding program rising once again to a new record at $102.7 billion, up almost $1 billion from last week, $800 million. While discount window usage slid $0.4 billion to $3.2 billion. Breakdown from the Fed's H41 table. QT securities held outright, $19 billion dropped to $7.701 trillion. Discount window borrowings down $0.4 billion and $3.2 billion. Bank term funding program up $0.8 billion to a new record $102.7 billion. Banks are insolvent. Other credit extensions, FDIC loans down $8 billion to $172.3 billion. Other Fed assets up $2.1 billion to $41.6 billion. U.S. equity market continues to charge ahead, even as bank reserves at the Fed contracted modestly. Finally, as a reminder, banks have 9 months left under the original 12-month by the fucking pivot program, Fed bailout program, to find a way to stabilize their balance sheet, back term funding program. Find a way to stabilize their balance sheets. Again, their balance sheets are insolvent. So, it's probably going to be another program to play accounting shenanigans, because those banks are insolvent. The toiletries that they purchase will be worth even less now than they were, about 3 months ago. So, not only have they failed to do so, usage of the bank term funding program facility set is at a new all-time high, and yields are rising even more. Greater mark-to-market losses. Again, they changed the way they mark those toiletries, and it doesn't change the fact that they're insolvent. And yeah, yields are only going to be rising, especially since they decided to print even more trillions of dollars, raising their debt ceiling, and pretty much ensuring that, that dollar is going to be worthless. So, yeah, that makes the toiletries even more worthless. So, yeah, should expect those to be insolvent, and as Yellen says, they're probably going to have a lot more mergers. A lot of banks going to be merging this year. Probably see some in the coming weeks, months. So, yeah, that's it for today's Better Than Bloomberg.